The whole idea behind supply and demand trading is to track big orders from big banks and institutions. Where is smart money sitting and how can I get in with them? So if we do see a move like this crazy gold move that we saw this past week, I want to be able to get in before most of it has already happened. And so really what supply and demand is creating these zones where we think the orders are sitting. So if we are looking for a potential bounce, we're looking for a demand zone to buy in. If we are looking for a potential short, aka somewhere where we might stall out, we are looking for a potential supply zone. So today's workshop is going to be, yes, about supply and demand trading. So if you're brand new to the concept, you can at least understand what it is and how to draw the zones. But it's also going to be geared towards people who have been trying to use the concept and maybe not succeeding as much. I am guilty of this. When I first started, I was not following these 3 key laws, and they are very, very important to be successful with supply and demand trading. So just to recap what we went over, right? Demand is where you want to look to buy. That is just using these 2 examples here. I like to use the basketball method. So if you have a really solid floor, it's a really concrete floor, and you've got a good ball, right, that's not flat, there's nothing wrong with it, and you bounce that basketball, you expect it to bounce pretty hard, pretty rapidly off of that floor. Now, if the ball's flat or the floor is pretty flimsy, maybe you're trying to bounce it on a trampoline, I don't know. But if there's something flawed with this setup, then you're not going to see the bounce that you're looking for. So I like to use the basketball theory because that is what a demand zone is supposed to replicate. So if a stock comes into a demand zone, you want to see that bounce effect off. You don't want to see it hit the ground and then just stay there for a while. No, you want to see it hit. Maybe it hits twice for a double bottom, but it still sees rapid movement off of that level. For example, going back to gold here, you see this rapid movement right here off of this base that was created. Well, I'm going to draw out this demand zone here, and I'm going to see if in theory we saw price action return to that level, and when we did, what happened. So you can see that we came close to it right here, and we did see a move up, but we did not hit this demand zone. We eventually hit the demand zone right here, and we did see movement up, but notice something, it was not as rapid as this movement right here. And that is because demand zones are created from left behind orders. So if we are looking for a demand zone, that means there's left behind buy orders from big dogs, institution, banks, whatever you want to call them, that were not filled. So when we come back to that zone, there should be buy orders still sitting there as long as the zone is fresh. Some zones are going to be stronger than others, and this one still had buy orders. And how do I know that? Because we came in and we saw movement react in a positive way back in the upwards direction. So if you were looking to take a long on gold, waiting for this demand zone to hit would have been a good place to do so. But how did this demand zone get created and how do we know? Is because of that basketball theory. The basketball came down to this floor and it bounced rapidly up. We don't want something that's just sitting here for a really long time. That would create more of a basic support level. We want that rapid movement. Now, the opposite side of that is supply. That's where you want to look to sell. So the sellers are more aggressive than buyers, often causing a rejection in that range. Now, remember the opposite of that, demand. The buyers are more aggressive than sellers, often causing a bounce in that range. So who is in control at each level will determine if it's a demand or supply zone. And the key word in all of this is going to be rapid movement from key area of interest. Rapid movement is absolutely crucial. So we can use this other little car going up a hill, which happens to mimic a trading hill, to show you guys an example of supply. So if you think about a car going up a hill, a mountain, whatever, eventually that car is going to get to an area where it likes to stall out. Maybe it runs out of gas or it just doesn't have enough horsepower to go up any further. Eventually it'll stall out and start to come back down the hill. Well, we actually used a supply zone, which I will draw with you guys in just a minute, this past week to take a nice short on gold. As you can see, we came up into the 2067 area and we saw a stall out. We saw sellers present, and therefore we saw us come back down in price action. So if we're thinking of that car theory, it kept going up the hill, it kept going, but eventually it was going to stall out because it was just going to become too steep run out of gas, whatever you want to say. And then once we hit a supply zone, there's a likely chance we could see that car stall out and start to come back down the hill. And to draw this supply zone, we have to go back a little bit, and then you can see that right here is where we saw the car stall out method. So we came really fastly up into this zone. There were sell orders here. We got knocked back down very rapidly. So therefore, when we revisit that zone, which you can see we did this past week, we were looking to take a short if we saw price action stall out in this zone. And you can see we came right up into it. So a nice few reasons to enter short, not just coming into a supply zone is going to be enough to enter a trade, but we did see sellers present, which warranted a short in this supply zone. Okay, so enough of supply and demand. If you're brand new, I hope you understand the basics. But now let's move into the 3 laws that I was referring to. So law number 1 is never chart a zone that lacks momentum. So what do I mean by momentum? Again, we're going back to that basketball theory. If I'm throwing a basketball on the ground, I want it to bounce up quickly. And if it doesn't, then I'm not really interested in bouncing it on that floor anymore. And using another screenshot of gold, you can see this little pink area that I have drawn here. Yes, we came down into this area and we found support and we moved up, but this would not be considered a demand zone for me, at least. Everyone does this differently because we didn't see rapid movement to the upside. We saw gradual movement to the upside. So charting notes down here, you can see, notice how we lacked clear momentum off this base. This would be considered more of a support level and not demand zone due to the lack of momentum, aka that bounce effect. Whereas this zone on gold right here that you can see I have drawn is actually more of a demand zone because we are seeing that momentum effect. We are seeing at least 3 strong candles off that zone telling me that this in fact means there are buy orders sitting here, which caused the momentum upwards once orders were filled. So charting notes, see how we have a clear sign of momentum via the 3 or more large body candles bouncing from that base. So that's just a little trick that I like to have in my brain is I'm looking for those 3 big momentum candles. And typically if we can get those 3 big momentum candles, big large bodies, not a lot of wicks, those are usually the better zones to look for. So here I would consider this a demand zone and I would chart this out to see if eventually we come back and test this zone where I would look to take a buy if I saw buyers present. Okay, law number 2 is only chart recent supply and demand zones. So sometimes you might have to go a little bit further back. So in that last scenario that I showed you guys on gold, this zone up here was actually from about a week ago, but it was not 20 days ago or 180 days ago. I typically don't go back further than a week, and if I do, it really has to be a strong zone that has not yet been hit, maybe from multiple gap up days. But the reason for that as well as only charting recent supply and demand zones is because let's use a watermelon for an example here. If you've got a slice of watermelon and you have a hungry kid, you can bet that that watermelon will be eaten up very quickly the more that kid comes back in the kitchen, right? So you've got a big slice of watermelon. Every time they're coming in the kitchen, they're taking a bite, and eventually that watermelon slice will be gone. The same thing is said for supply and demand zones. Every time we enter that zone, it's going to become weaker and weaker and less because there are left behind orders. Eventually, those orders are going to be filled. And what used to be a supply and demand zone might actually just turn into a resistance or support zone at that time because most of the orders have been filled, right? So in this scenario, you can see there is a supply zone and we came back to hit it the second time, which would have been a great short entry, you can see. However, the third and fourth time we did still sell off, but the zone was not holding as strong because we were able to come above that zone a little bit more each time. So it doesn't mean old zones aren't valid and aren't places to look for that price action, but just know the more a zone is hit and the older it is, the less powerful it is likely to be. So just to recap what I just said, older zones that have already been hit more than once can tend to fade in strength as previous orders have already been absorbed. This is why you want to put more emphasis on recently created, aka fresh zones instead of older ones. And that brings me to law number 3, the last one here, and that is never use supply and demand zones solo for entries. And I want to rephrase that. You should never use any trading model solo, whether that's an indicator, a strategy, whatever you have created, whatever your edge is. Usually a really solid edge has 2 or 3 components to it. It's not just one main thing that you do, and then when that one thing happens, you execute and it works. If that's the case, kudos to you. I have not been able to find something that will work consistently just using that one thing. You typically have to take in market context and other conditions and other scenarios as well. So I give you guys an example of what my thought process would look like if I was using a supply and demand strategy. Okay, so take this little circle chart here. If I am using supply and demand as my main reason for entry, that is going to be a large part of this circle. So I am considering a long trade as we enter a demand zone. That would be my thought process based off me using supply and demand. However, when we enter that supply and demand zone, I'm still asking myself these two other questions, okay? Those could be, am I seeing strong buyers present on tape or level 2? These are just examples. You don't have to use these. And then the second one being, we are making higher lows in the zone. That is a question I need to ask myself. Are we making higher lows, or are we still seeing lower lows form? Meaning I should not be looking for a reversal trade off that demand zone until I can see higher lows being formed. So going back to the gold example here, you can see we came back into the demand zone. There were several reasons actually to enter this trade. So we had a downtrend here, just a basic downtrend. And then you could have branched off that downtrend here and got an earlier entry. However, we hit the demand zone, came back up, eventually broke this downtrend. That is another reason that I would have considered a long trade. So not just the fact that we entered a demand zone, but also the fact that we broke trend to the upside. And so if I was looking for reversal off a demand zone, I want to see these types of things. I also can see divergence on RSI, and then we made a higher low right in here over that demand zone. So multiple different reasons for me to enter this trade long. I didn't just say, let me enter because we're in a demand zone. And I oftentimes see traders make those mistakes is they aren't taking into context multiple different things, because you can see this scenario right here would have been a great example of why you don't just immediately enter long when we are hitting a demand zone. We already hit it the second time. So when we came back the third time, we had no buy reaction here. We went straight through this demand zone and actually entered an old previous gap, which could have had left behind buy orders as well, but that took you looking left and taking into factor other things. So if you would have just been the type of person who immediately buys when we enter a zone, this would have really bit you in the butt. You would have gotten stopped out and then been really pissed off when it reversed and did this insane move, which again happens to the best of us. But the key thing here is don't just use it by itself. Don't use any trading strategy or indicator by itself. Make sure you are taking into context multiple things, and that should give you that edge and upper hand when it comes to your trading. And that's a wrap for today. I hope this 3 laws of supply and demand trading workshop was helpful for you guys. If you are interested, I have that free futures trading workshop that I just created for 2024, linked down in the description box as well as the pinned comments. If you want to follow me on Instagram, I have my personal as well as the Peachy Investor link down below. Don't follow any other accounts. I'll never request to follow you. I will never direct message you. They are all scammers. Please block and report. If you guys enjoyed this video, make sure to give it a thumbs up, and I will see you guys next time.